Hi, I'm Andrew Glaze, CEO and founder of WellStack, and I'm here today to talk to you about Silicon Valley Bank and its $209 billion spectacular and sudden collapse. We're going to talk about what happened, why it happened, and what it means for you as an entrepreneur. So, what happened here? Classic run of the bank. At a high level, banks operate by collecting deposits from individuals or businesses and then using that money to go out and originate loans and write loans to other businesses. They collect interest on those loans, a portion of which they give to the depositors, and a portion of which they keep for themselves as a bank called the spread. And that operates and works perfectly well as long as only a small portion of the people that have their deposits seek to get their money out. So the banks keep a portion of money on hand, but again, most of the money is lent out at all times, and this is how all banks operate. What we had here was, as a result of macro factors, where VC has been pulling back on deploying capital, uh, operating businesses that had been backed by VCs were going to Silicon Valley Bank and taking their money out to make payroll and for general corporate purposes. Well, with less money coming in because the VC's pulling back and all these individuals coming in getting their cash, you got set up for what's called a run in the bank. Let's talk about why this happened. And so at WellStack, we work with a number of different financial institutions. We've got over 150 different financial partners on our platform that we're able to allocate and connect you to. And what's really interesting, and that includes Silicon Valley Bank, and what's really interesting is that amongst all the different community banks and banks in general, Silicon Valley Bank is the only bank that offered venture debt as a product. JP Morgan Chase doesn't offer it. Bank of America doesn't offer it. Certainly the small regional community banks don't offer it. But it made sense for Silicon Valley Bank, which has worked in hand with startups and with VC companies for so many different years, to offer the financial products that those individuals need, and venture debt is foremost amongst them. And so you really had a unique combination of a run on the bank, a number of potentially illiquid loan products that they had outstanding, as well as macro factors with VC starting to draw down the amount of capital they're putting out, all came together to create a perfect storm over the past few days. Now, what does this mean to you? As mentioned, Silicon Valley Bank were some of the people that were on a platform, that we've got 148 others. And so there are tremendous opportunities for you to find diversification. If you are impacted by this in any way, shape, manner, and form, you should be looking for other financial partners and other means of accessing capital. WellStack is certainly here to support you in that. There also potentially will be some businesses that, because of lack of access to cash, could potentially be available for M&A. And so I would encourage all enterprising entrepreneurs out there to keep their eyes open for opportunities around those areas in general. Now, if you are venture backed and you're going to be seeking to raise venture capital over the next few months, you likely are going to experience some tightening. You should experience significant tightening within venture debt. But again, I'm Andrew Glaze, CEO of WellStack. We're here to help. And so if there are any questions, please reach out. Take care.